Okay, so we're going to take a look at undervalued options, simple criteria to use on power options to find undervalued options, but also some of the thought process of, is it a good idea and is it a bad idea? Let's take a look. This comes directly from Bernie. Bernie sent me a question yesterday, as a matter of fact. It says, I viewed 2 videos whereby your topics indicate over and undervalued options from April 10th, 2019 and August 27th, 2019. In each of those views, you touch very little on undervalued options. They were emphasizing covered calls or diagonals, so we were talking about overvalued options and ratios when doing a diagonal, buying a farther out call and selling a nearer term call, for example. We want specific IV-HV ratios, want to look for selling into overvalued options and buying into undervalued. The main question, is there a way you can demonstrate undervalued options for long calls and vertical spreads? Well, absolutely. There are 3 basic filters we use on power options to identify if an option is considered overvalued or undervalued. And I say we do this on power options, but these are also the most common ones that are used by options investors as far as we know. The first one is the Black-Scholes ratio. Okay, it's just a simple comparison of the actual trading price of the option compared to its Black-Scholes theoretical value. There's a Black-Scholes 50-day and an SIV. We'll discuss those in just a moment. The other basic filter that's used is the implied volatility. That refers to the implied volatility of the option divided by the historical volatility of the stock, or what's known as the IV over HV ratio. And we also have an IV over SIV ratio. If I'm looking to buy long calls, I'd probably be using potentially all 4 of those. We'll explain why in a moment. A third one that is commonly used is the percent implied volatility range. And the percent IV range shows us where the option's implied volatility is now compared to where it has been over the life of the option. So I want the 3 filters to be in conjunction with each other because I want all 3, or technically all 5, to make sure that I'm looking at an undervalued option. Now, last night when I was working on this presentation, I created a basic search we might look at later on, but we created a basic search here to look for positions that matched this basic criteria, looking 30 days out in time to find options that matched all of the undervalued criteria. And you see some common names you'd expect: Disney, AstraZeneca, Wells Fargo, ICI Bank, Comcast Corp, Qualcomm. Seagate Tech was a little bit of surprise, and Starbucks. Right now, since they've already passed their earnings essentially, the options looking forward are considered undervalued from what the stock has been doing and what their theoretical value should be as well. Let's take a deeper look into each criteria. The Black-Scholes ratio is a simple ratio. The actual trading price of the option in the market divided by its theoretical worth, the Black-Scholes pricing model. Black-Scholes pricing model uses 5 criteria: stock price, the strike price, are we in the money, out of the money, is there intrinsic value, and so forth, the days remaining to expiration for your option, the current free interest rate on the market, and the underlying stock volatility, where the stock has been moving over a set time, over, say, the past 50 days, 100 days, and so on. Now, over on the right-hand side here, you see our view from the stock research tool. This is the March 180 call that came up in that search looking for undervalued options last night at the close that matched all of these individual criteria. And you see here there is the Black-Scholes 20 and the Black-Scholes ratio 20, less than 1. The Black-Scholes ratio 50, Black-Scholes 100, and 250, and what's called the SIV. Why do we show 4 or 5 different Black-Scholes numbers? And that's because the stock volatility, as I mentioned, can be measured by 50-day interval, well, even 60-day interval, 100, 200, and so on. So we're measuring it. You could see the view, I should say, that we're measuring it for each one here to determine if it's undervalued based on the Black-Scholes pricing model using the different volatilities. Now, as we can see here, all of these are less than 1. And what does it essentially tell us? Well, Black-Scholes ratio of less than 1 means the actual trading price of the option is less than the theoretical value. In other words, the current price is undervalued. Black-Scholes ratios of greater than 1, either 50-day or SIV, means the option is overvalued. The actual trading price is higher than its theoretical worth. So we've already addressed the overvalued, but when looking for the undervalued, I'm looking for a Black-Scholes ratio of less than 1, or maybe even less than 0.9. What does a Black-Scholes ratio of 0.9 mean? It means that theoretically, the option is 10% undervalued from its theoretical worth. That's the way to look at it. You could start with a value of 0.9 instead of just less than 1, depending on how, quote unquote, undervalued you're looking for. What are the two Black-Scholes ratios I've been mentioning? Well, we already talked about how volatility is one of the 5 criteria that's used for the Black-Scholes pricing model, the stock volatility. And this can be measured in 20-day, 30-day, 50-day, 60-day, 100 and 250, and so on. Similar equation is used for delta. So if you're looking at your broker, you're looking at an option chain, and you see a delta of 0.65, and you come over to PowerOptions and you see a delta of 0.63, and you wonder why are they different? It's because we're typically using the 50-day when looking at those type of equations. Your broker might be using a 250-day or a 100-day, or they may even be using a shorter term 20-day to calculate some of those criteria. What is this SIV? Well, this is a popular way for options investors to evaluate volatility. It's called the Stock Implied Volatility Index. Rather than comparing the implied volatility directly of the option or using the stock volatility for the Black-Scholes equation, in this case, the SIV is the average of in the money and out of the money implied volatilities for calls and puts in the near term expirations, usually under 60 days out in time. So that actually reflects upcoming earnings or potentially other events. We show both so that you can look to see if your option is considered undervalued based on the 50-day stock volatility, or if your option is undervalued compared to the implied volatilities of the other options around it, which may be factoring into, again, that upcoming event. So those are the two differences: a 50-day volatility on the stock, what has its volatility been the past 50 days, and the SIV, the average implied volatility of the options near term surrounding your particular option. Criteria 2 that was used: the implied volatility versus historical volatility ratio, or the implied volatility IV over the stock's implied volatility index. Here we're simply comparing the actual implied volatility of the option you're researching against the volatility of the stock, or the stock's implied volatility index, the implied volatility surrounding your option. Same as before, a filter of less than 1. So an IV-HV ratio of less than 1 means the IV, the implied volatility of your option, is lower than the stock volatility, which implies that it's undervalued compared to the movements of the stock. An IV over SIV, or IV-SIV ratio of less than 1, means that your implied volatility of the option you're researching is lower than the average implied volatility of the options surrounding it. Therefore, it's considered undervalued compared to its comparisons, in the money, out of the money, or more. So that's what the IVs tell us. Is comparing the direct implied volatility of the option to the volatility of the stock. That's IV over HV, a value of less than 1. Again, a value of 0.9 would mean that the implied volatility of your option is 10% lower than the historical volatility of the stock, or the option surrounding it if you're using the IV over SIV. Another way to look at it is IV is the future expectation of movement of the stock based on fear gauge or upcoming events versus the past trading history of the stock or the historical volatility. Two differences again. Why are there two different ones? Same reason as before: to compare against the past recent trading range of the stock or the near-term options surrounding it. Want to give a major caveat here. If you're looking for long options, that was Bernie's first part of the question, long option or vertical spreads, but you're looking to buy calls that are 90 days or 100 days out in time, the IV over SIV might not be the right one to use in that scenario, honestly, because it's looking again at options that are, under 60 days out in time or the next two expirations or so. And the average implied volatility is in the money and out of the money calls and puts for that shorter time frame. If I'm going out 150 days, 180 days, I'm probably more focused on the IV over HV, not necessarily the IV over SIV or the Black-Scholes SIV. But if you're looking to buy calls that are 25, 35, 45, maybe even 60 days out in time, I think using both IV over HV, IV over SIV, and the Black-Scholes 50-day and Black-Scholes SIV ratios, I'd use all four. That third criteria I mentioned is the percent implied volatility range. This is where the options implied volatility is right now, compared to where it has been over the life of the option since this exact option was released on the market for trading. Okay, so we see here, this is the Disney call, I believe, not GWPH, I don't think. This is actually the Disney call. Yeah, it is. It's the Disney call we're showing at the bottom. So here in our results, we had the Disney 180 call that matched all of the criteria. IV over HV of 0.84. What does that mean again? The implied volatility currently at 0.3341 is 16% lower than Disney stock volatility. IV over SIV of 0.99, right there but close. Black-Scholes ratio of 0.85. It's 15% undervalued compared to the option's theoretical worth. We see that when the first time it came out was just before September. So sometime in August, probably after standard August expiration, was when this Disney March 180 call started trading on the market. Hit at a pretty deep low into September, and that was interesting, wasn't it? Because that was when the market was taking that 10% decline. But this 180 option hit a low IV, moved up here, settled back down. Probably up here was the most recent earnings event, where the IV spiked up to 0.44, and now it's already back down to 0.3341. So you see that it's near that lower range of where it has been over the life of the option. The percent IV range is only at 21%, from where its lowest point was at about 0.319 to 0.44, we're at 0.3341. IV range of 21%. So that's just another way to gauge an undervalued option, is looking for options that are near the lower end of their implied volatility. Why is that important? Well, when I'm buying options, buying calls, or maybe even doing a vertical spread, I hope that when something starts to move, that volatility will start moving in my favor, that not only will I get an intrinsic gain of the stock moving up in my favor, so my call is gaining in price, but if the implied volatility also kicks in, that's going to give me a little bit extra return. So the stock moving in our desired sentiment plus an increase of implied volatility moving from a new low, maybe back up to 0.38 or 0.39, it's going to give me an extra premium, hopefully when I'm going to sell the position. What filter to use? A percent IV range in the long call or long put search of less than 30 is a good start. You could also tweak that further and say go less than 20 that example, or even less than 10, but you might be mitigating several positions out. But a good start is to use an IV range, percent IV range of less than 30. Those are the filters that we use. Oh, I have to add this. I apologize. Is there anything to consider with percent IV range? Yes. You want to take it with a grain of salt and compare it also to its total range. What do I mean by that? Now, this one's a pretty good one. It's wild, but it's pretty good. Here our percent IV range is at 1 for this ACIA position. Going to the stock research tool and the option research tool, we see the details here that the total range of implied volatility over the life of this option is 0.0133 to 0.1644. It's about a factor of 10, isn't it? The current IV is only 0.0152. If this starts to go back to 0.05, 0.06, that's probably going to up the volatility and up the premium for this particular option as well. That's going to be a pretty good sign. But if I find an option that has a 1% implied volatility range, and I either add the actual IV range to my columns, or I go to the research tool to look at, And over the last 6 months, the total IV range is 0.444 to 0.462. And right now it's at 0.445. The actual IV, well, this is a very tight range. I'm not expecting to get any real emphatic burst of premium for an implied volatility range if it goes back to its high, because that's only 0.02 away, actually 0.018 away. It's not that big of a move. So when you see a high number of 90, 99, or a very low number of 1, you want to check the actual range of volatility to see if there's any hope that if it goes back to the norm or back to the middle, that would benefit your position due to the implied volatility increase as well. Now, here's the simple entry that we would use. This again is for a long call or a long put position. William asked a question. I thought that was going to come in. William asked the question, is the IV percent implied volatility range the same thing as IV percentile or IV rank? It's close. It's pretty much the same as IV percentile, not IV rank. IV rank is a little bit different. We prefer to use the percent implied volatility range ourselves. A little trick on that for you, in a sense. We're going to see that, William, in just a moment. So I'm in the Power Options screen. I'm in the Options section. I want to look for undervalued options, the starting point. And again, you could change it to your needs. I'm going to look for a Black-Scholes ratio 50-day of less than 1, blank to 1. Look for also a Black-Scholes ratio SIV of less than 1 if I'm looking at options that are 25, 35, 40 days out in time. If I'm going 90 days out, I'm probably just focusing on the Black-Scholes ratio 50-day, IV over HV. But if I'm shorter term, I'm using all 4, Black-Scholes ratio SIV and the IV over SIV. And the starting point is less than 1 to look for undervalued options. And I'm also going to look for a percent implied volatility range of less than 30%, if this is my goal. Okay? Now, does it work? Let's take that basic criteria. I'm going to limit the stocks to just be between $10 and $300. We're going to look at options that are just maybe 1 strike in the money or 1 strike out of the money for any options that match that entire default criteria set. This was done last night on the historical tool. I didn't want to run the historical tools live today, as you know, because we're uploading all of the data and sometimes the tools get slower. So I wanted to do this last night after hours, of course, when I had the time, so that we could go through it quickly. But here we go. 28 days out, low percent IV range, IV over HV and SIV less than 1. There's that, the strikes in the money, just focusing at or sort of just in the money or just out of the money. 1 result per security. 50-day Black-Scholes ratio and SIV, Black-Scholes ratio less than 1. And I want some general liquidity. Option volume greater than 10, open interest greater than 100. And again, stocks between 10 and 300. That was the basic quote-unquote undervalued search I created last night. And then we ran a search. Went back to November 23rd. Now remember, of course, we're looking 1 month out to expiration. We sorted by the Black-Scholes ratio, 50-day, lowest to highest, the most undervalued options in that case. And these were some of the trades that came up that were rated as undervalued based on that criteria. Xenia, Eaton, Associated Bank, Starwood, HD Supply Company. I think Ernie's in that in a married put, or was recently. UBS Group, Brookfield again. Oh, Brookfield Asset Management versus Brookfield REIT. So of the top 15 results, sorted by the lowest Black-Scholes ratio 50-day to highest, in that 30-day time period from purchasing on November 23rd for the December 15th expiration, only 1 out of 15 turned a profit. The average return was minus 81%. During that time, that 23-day period from November 23rd to September 18th, the Qs were up 6.3% and SPX was up 3.6%. It was a slightly neutral to bullish market. But the undervalued options in this sort, believe it or not, did not turn a profit. Does changing the sort matter with the results that you have? Well, we didn't really restrict the results too much because in that case, we were just looking to fully isolate undervalued options. Let's run the same search again. Same date, November 23rd, but now we're going to do Black-Scholes ratio SIV. And this time, 2 out of 15 were successful. But with the gains that we had on those two, with a different sort, it changed the order. So we looked at the top 15, there was a 0% return. That's a huge difference in sorting, isn't it? From just going to Black-Scholes ratio 50-day to Black-Scholes ratio SIV. And because I'm using a 25-day out option, in this case, in this example, I know most of you wouldn't be doing that. This was just an exercise, but just looking 1 month out for undervalued options. This brings home the point why I want to use the SIV as a filter. Not necessarily as a sort, but I want to use it as a filter because it's relating to all the options around it. Again, 90 days out, you might not be using the SIV. But let's go on. We've got other filters, didn't we? Same search, November 23rd. Change the sort again to IV over HV, lowest to highest. 3 out of 15 were successful, but it was a 67% loss. In other words, adding up all the gains and losses of those 15 positions, assuming you did the same monetary allocation, gave you a loss of 67.5%. IV over SIV, lowest to highest. Only a loss of 28%, but 4 out of 15 were successful. Now, here's an interesting thing. Same search criteria did not change anything. Same search date, November 23rd. Changing the sort to percent IV range of lowest to highest, the options that had the lowest implied volatility over their life of their options for that December expiration, just 25 days away, 8 out of 15 were successful for a 25.3% return. I was shocked by that, to tell you the truth. I was shocked initially seeing an 81% loss on undervalued options in an up market. But again, I was surprised that the changing in the sort, I've seen this before with my own searches and historical tests I did for bull puts and other strategies, but this one was glaring. It's the same exact search. Same exact 1 month time frame where the markets were up 6.3 and 3.6% respectively, tech versus S&P 500. And this one, just changing the sort, gave us a profit instead of a 67% loss, an 81% loss, or even the 28% loss as well. Now, I'd be remiss if I didn't do the next step here. And what is our next step? At the beginning of the presentation, I mentioned that we have default settings in over 23 of the most commonly used option strategies for options investors. And Ernie's tested long call search he prefers to use is the Bollinger Band default screen. I took the Bollinger Band default screen, ran it on November 23rd, same date as the others, and took an end date because these are looking for further out options. You see, we're February, April, March. But I looked at what the returns were on the end date of December 18th. You can see that all here. All the ending dates are 12/18. Sorted by that percent implied volatility range again. And now we're 12 out of 15 successful long calls for an average return of 78.6%. What does this exercise do? Well, this was an answer for Bernie to show how to use those criteria to filter specifically for undervalued options. Why are we using the Black-Scholes ratio 50-day and Black-Scholes ratio SIV, IV over HV, and IV over SIV? When wouldn't I use the SIV ones? It's when I'm 90 days or more out in time. Do I want to look for undervalued options when buying options or going in diagonal spread? The answer is yes, but without other criteria to screen for stocks that have good fundamentals, showing good technical performance, such as the Bollinger Band breakouts that this search is looking for, as well as other criteria, it doesn't mean it's going to be successful just because you're buying an undervalued option. I just wanted to show this because those undervalued, many of these might not even be considered undervalued, but you see the difference in results over the same exact time frame between the different searches that were there. Okay. And that's what I wanted to kind of illustrate and point out here. And I'm actually going to run some new tests. Ernie right now, because that's how he tested this Bollinger Band screen. He's sorting the results, I believe, by the highest earnings per share growth, with the belief that earnings has been driving, earnings drives the underlying market for long calls and looking for the Bollinger Band breakouts. And again, I want to go back and take his results over run his test over the last couple of months or last year, looking every 2 months at a time or whatever, and then compare it against changing it to sorting by the percent IV range to see if I actually get a little bit better performance on those as well. Okay. Oh, Bernie says, Mike, since I was late getting in because I had no link, my question is that a majority of my trading has been weeklies or 2 weeks out. So will this work for me if I can change the BS50? I would use the BS SIV. But again, I still think you want to use the Black-Scholes 50. When I say use the BS Black-Scholes ratio or the IV over SIV, if you're 90 days out or more, is because the SIV is looking for shorter term than that. Okay, the average of the near term in the money calls and puts. But I still, even if I'm doing a weekly or 2 week out, Bernie, I still want to compare it to the Black-Scholes 50. Because even if I'm trading 7 days out or 14 days out, excuse me, Bernie, I still want to compare it to what has the movement of the stock been over the last 50 days. I still want to see that. Even if I'm going 3 weeks out or 4 weeks out, I still want to see that comparison as well in that case. So I would use both when doing that particular one. Now, that quick follow-up question, we're not going to get too deep in this. It's already at 5 o'clock, and I want to get to that other question that came in via email and some of the other live questions that came in as well. We took the ACI example, and I did this afternoon because I ran out of time last night. I got too tired. It was 1:30 when I finished that portion of the slides. But in any case, the vertical spreads become extraordinarily tricky when you look for undervalued options. Why? Notice that IV over SIV here. And you can even see it with the Black-Scholes ratio, 50-day and the SIV. The lowest, well, in this case, that doesn't work out here, but the lowest ones are typically right here. The lowest values are right at the money. And then, in this case, they're all increasing, meaning I'm getting less undervalued as I go deeper in the money. The percent implied volatility range is less as we go deeper in the money and deeper out of the money. And the IV over HV is very similar. It's getting higher, less undervalued as we go deeper in the money. Why is that important? You mentioned a vertical spread, Bernie, being undervalued, which to me directly implies you're looking at a bull call debit spread to pay less into the position. Unfortunately, it's the opposite. When you have an undervalued option or series of undervalued options, where are you selling? You're probably selling a couple strikes in, maybe right at, but probably a couple strikes in, looking for reasonable probability, of course, in this case. And where does that leave you with? Look at these midpoints. If you did this stock's at 115, so if you went 15% in the money and sold the 100 call and bought the 95 call, your midpoints are exactly at a debit of 5. You'd pay 20 for the long and get 15 for the short, which means what? You're paying a $5 debit to get a $5 strike difference, which is 0% profit. Going at the money, selling the 110, buying the 105 for that bull call debit spread, 955 to 520. That's actually not too bad, but you're paying $4.35 to get 65 cents back. That's pretty reasonable in this case. But again, and this kind of goes to Webb's question, what is too deep in the money? Well, too deep in the money is when I'm trading almost right at intrinsic value and there's no viable spreads I can find because they're all 5 points apart. That's very tricky. Why is this happening? Because I want the option that I'm selling in a debit spread, much like a calendar spread, to be overvalued and hopefully this to be undervalued. But as you see with these curves here, as you go deeper in the money, the implied volatilities tend to increase, of course, or deeper out of the money, the IVs tend to increase away from the at the money strikes. and you're seeing less undervalued options, mainly because of that higher implied volatility for the deeper in the money options. So you're paying more and selling for less, and you're not getting a good spread in that position. It's not a good idea. I want the reverse almost in this case. I'm not saying you want to just trade overvalued vertical spreads. That's not what I'm saying. But when you do a bull call debit, if you're looking for options that are too undervalued, that may mean that the options surrounding it are undervalued too. But to create the vertical, you're going to end up in a position where that's not true. Okay, so, and William brings up a point where we're getting off topic here for this, but it's the correct question, William, don't get me wrong. William's talking about now, will this be a good idea if I looked out 90 days and found a long call that was considered undervalued? Good luck. We might cover that later based on a coaching session I had this week. If I go 90 days out and I look for an undervalued call and I buy that and then I wait for the stock to move up or implied volatility to increase to sell something nearer term or even the same expiration. You know, his direct comment is, instead of a vertical, could one do a long call when IV is low and then put in a short call later when the IV range starts to rise? Well, you could do that. What's the risk now? You buy the call at low IV expecting the IV to rise. The IV doesn't rise, and in fact, it falls. Or the IV rises because the stock is falling. Now you're no longer in a position that's really bullish. The sentiment's no longer bullish, so it's much harder to do that bull call vertical. Legging into a vertical spread can be tricky as well. We may want that. That would be great in theory, William. You're absolutely correct. Just like the diagonal spread. I want to buy into an undervalued low implied volatility option and sell into higher implied volatility if I get my way, nearer term, if I'm doing a diagonal. Or if I can leg into the vertical, I buy something that's 3 months out and 15 days from now, IV rises and I sell the rest of the vertical matching the same expiration. Okay, that would look a little bit better, wouldn't it? That would be great. But what can happen in that time frame if it doesn't go as I expected? How much do I start losing on that long leverage call before I'm able to sell the call in that case? So that's where the low, undervalued positions can become tricky with the debit vertical spreads, because you want an option to sell technically that's considered overvalued, which means the option that you're buying is got to be overvalued as well. And if I want to buy into undervalued, I'm likely selling into worse undervalued by all four metrics: IV over HV and Black-Scholes ratio, and IV over SIV as well. In that case, these ones are actually, highly overvalued in that case with the IV over SIV because the near-term volatility. But the 50-day, it's getting less and less undervalued as you go deeper in for the calls you'd be buying to complete the spread position. All right, so that is my discussion for now on undervalued and overvalued options, how to use power options to find them, why we use those criteria, the risks of doing it, and something that shocked me actually with doing the same search, but changing the sort took us from an 81% loss to what was it, a 28% profit with just looking for those undervalued options. But again, looking at that same time frame, the default search on power options, which includes other options criteria and the stock criteria for positions, was much higher and much more successful. There's more to it than just looking for undervalued options. You still need those underlying metrics.